Have you ever found yourself, gazing at real estate listings, maybe picturing that perfect little getaway, a cozy cabin somewhere quiet, or maybe a beach house right by the water?
Oh, absolutely. That dream of escaping.
Exactly. You imagine those blissful weekends, quiet mornings, just pure escapism, right? But then that practical side kicks in.
The what if side.
Yeah. What if I could rent this out when I'm not using it? Turn that dream into a little extra income. Suddenly the fantasy feels, well, a lot more doable.
And potentially a lot more complicated tax-wise.
That's exactly where we're headed today. This deep dive is all about navigating the fascinating but, yeah, often intricate world of tax implications for rental income from those dream vacation homes.
Right. It's about understanding how the IRS views that rental cash and, just as importantly, those expenses.
Our mission today is really to cut through the confusion. We want to clearly define the different ways your vacation home might be categorized for tax purposes and uncover the key rules that dictate what income you report and what expenses you can deduct. We'll even look at how different interpretations of the rules can impact your tax bill.
It can make a surprising difference.
Before we dive deeper, though, just a quick reminder that this deep dive is based on material from Farhat lectures.
Great stuff over there.
Absolutely. All the content, examples, explanations, it's all derived from the comprehensive accounting resources at farhatlectures.com.
So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, loads of support to reinforce today's topic.
And a special thanks to Professor Farhat for providing this valuable material for our discussion.
Yep.
Okay, let's unpack this because here's where it gets really interesting. Your vacation home isn't just one thing to the tax authorities. It actually falls into one of three distinct tax categories.
That's right.
And how it's classified fundamentally changes everything, how you report income, what expenses you can claim. It's not just about how often you rent it out.
No, it's also about how much you use it personally. Understanding these classifications is absolutely the first crucial step. We're talking about primarily personal use residence,
Right.
primarily rental use property,
Right.
and then this kind of hybrid category, the personal rental use residence. Each has its own set of rules, and yeah, a misstep here could mean leaving money on the table or, worse, an unexpected tax headache.
Okay, so let's start with what sounds like the simplest one. Primarily personal use residence. What defines this category, and what's that surprising twist I've heard about?
Well, a vacation home falls into this category if it's rented for less than 15 days during the entire tax year.
Less than 15. Oh,
Yeah, think of it as really minimal rental activity. You mostly use it for yourself, maybe just renting it out for a very short period, like, for a local festival or one specific event.
and the surprising twist.
Here it is. If your property meets this less than 15 days rule, you are not required to report any of that rental income.
Wow, really? None of it?
None of it. It's completely tax-free. The flip side, though, is that you generally cannot deduct any expenses associated with that rental period.
Oh, no.
Except, and this is important, except for qualified mortgage interest and real estate taxes. Those two specific expenses can still potentially be deducted on your Schedule A, the form for itemized deductions.
But not against the rental income itself because you're not reporting it.
Exactly. It's almost as if the rental income and most of the related expenses just never happened for tax purposes.
That's quite a perk. Can you walk us through an example? Maybe Garcia again.
Sure, let's take Garcia. She owns a lovely beach house. This year, she rented it for only 10 days, brought in $2,300.
Okay, just 10 days.
Right. The house was vacant otherwise. Now, during that period, she had various expenses, utilities, some maintenance, depreciation, property taxes, mortgage interest, the usual stuff.
So because it was rented for just 10 days.
Yeah.
Less than 15.
Precisely. Garcia doesn't report that $2,300 income. Zip. When it comes to our expenses, only the property taxes and mortgage interest, which, let's say, totaled $1,500, are potentially deductible.
And those go where?
On her Schedule A as itemized deductions, if she itemizes. All the other expenses related to the house during that time, utilities, maintenance, depreciation, they're just not deductible at all. They're treated as personal expenses for a property that's mainly for personal enjoyment.
So the bottom line here, rent your place for under 15 days. That income is basically a tax-free bonus.
Pretty much.
It simplifies things a lot. But you do give up most of the expense deductions related to that rental. It's a trade-off, I guess.
Yeah.
Simplicity versus maybe more deductions.
Exactly. Which brings us nicely to a more involved scenario. the primarily rental use property.
Huh.
This sounds like, as you said, the serious landlord category. It definitely is. This category applies when a property is rented for more than 15 days. So you're over that initial threshold.
Okay.
And this is key. It's not used for personal purposes for more than the greater of either 14 days or are 10% of the total rental days.
Whoa, okay, say that again. The greater of 14 days or 10% of rental days.
Right. So for example, if you rent it for 200 days, 10% of that is 20 days. Since 20 is greater than 14, your personal use couldn't exceed 20 days for it to qualify as primarily rental.
Got it. So your personal use has to be pretty minimal compared to the rental use.
Exactly. It's essentially treated almost exclusively as a business property for tax purposes.
And I imagine the tax implications shift dramatically when the IRS views your property this way.
Oh, absolutely. Night and day almost. All of the income you earn from renting this property must be reported, no surprise there.
Right.
But on the flip side, you can deduct all the associated expenses related to the rental use. And here's where it gets really interesting.
Okay.
Unlike the personal use category, you may actually report a net loss from this rental activity.
A loss. So expenses exceed income.
Correct. And that loss, assuming you meet certain other rules, the at-risk rules and the passive activity loss rules, can often be deducted against your other income, like your salary.
Wow. It's a significant advantage if your expenses are high, maybe in the first few years.
It absolutely can be. That ability to potentially report a deductible loss is a game changer.
Is there a catch with those at-risk and passive activity loss rules? Are they complicated?
They can be, yes. They're basically designed to prevent taxpayers from creating artificial losses just to offset other income. But for a genuine rental business activity, it's often achievable and a real benefit.
Okay. And any other key changes for this category?
Yes, an important heads up, especially after the Tax Cuts and Jobs Act of 2017. For this type of property, the mortgage interest is generally no longer deductible as an itemized deduction on Schedule A.
Why not?
Because the property is now primarily classified as a business or rental asset, not as your personal residence for the purpose of that specific itemized deduction. The interest becomes a rental expense instead.
Makes sense. Okay, let's bring Garcia back. How would her beach house look under this serious landlord scenario?
Okay, different scenario for Garcia. This time, she rented her beach house for 40 days, bringing in $5,200. She also used it personally, but only for 10 days.
Okay, so 40 rental days, 10 personal. How does that fit the rule?
Well, she rented for more than 15 days, check. And her 10 personal days, is that less than the greater of 14 days or 10% of the 40 rental days? 10% of 40 is just 4 days.
Ah, so 10 days is not less than the greater of 14 or 4. Wait, oh, I see. The rule is personal use can't be more than the greater of 14 or 10%, so 10 days is less than 14 days.
Exactly, you got it. Her personal use is 10 days, which is less than 14 days, the greater of 14 or 4. So yes, it qualifies as primarily rental. She stayed under the personal use limit.
Phew, okay. Glad we cleared that up. So she's definitely in serious landlord territory now. What about her expenses?
Okay, let's say your expenses were utilities $1,200, maintenance $700, depreciation $1,000, property taxes $1,700, and mortgage interest $2,560. First, Garcia reports the full $5,200 income. Now, because this is primarily rental, expenses related to the rental use are deductible. We need to allocate them.
How do we do that? Based on rental days versus total days used?
Correct. Total used days are 40 rental plus 10 personal, so 50 days. The rental portion is 40 out of 50, which is 80%.
Okay, 80% rental use.
So we apply 80% to expenses like utilities, maintenance, depreciation, and mortgage interest. For property taxes, often you allocate based on rental days, total days in the year. But for simplicity here, let's assume we allocate based on use days too, or follow the specific guidance for rental properties. If we apply the 80% rental use allocation to all those expenses.
Let me guess, the math works out interestingly.
It does. Her total deductible rental expenses add up to $5,728.
Which is more than her $5,200 income.
Exactly. This results in a net rental loss of $528.
And crucially,
This $528 loss is deductible for calculating her adjusted gross income, or AGI. Assuming she meets the passive loss rules, this can directly reduce her overall taxable income.
that's powerful. What about the personal portion of expenses? Like the other 20%?
Good question. The personal portion of the property taxes, which would be 20% of $1,700 or $340, could still potentially go on Schedule A as an itemized deduction if she itemizes. The personal portion of mortgage interest, however, generally wouldn't be deductible here because it's primarily a rental property.
Okay, so the key insight here. When your property is primarily a rental business, you report all income, deduct allocated expenses, and you can actually generate and deduct a tax loss, potentially offsetting other income.
That's the big takeaway. It shifts your tax planning from just, managing income to potentially actively reducing your overall tax burden, a fundamentally different game.
Which brings us to the third category, the personal rental use residence. You called this the hybrid and maybe the toughest one. How does a property end up here? It sounds like a tightrope walk.
It really can be a balancing act. This is the hybrid category, kind of stuck in the middle. It applies when the property is rented for more than 15 days.
Okay, like the last one.
But it's also used for personal purposes for more than the greater of 14 days or are 10% of the total rental days.
Ah, so you cross that personal use threshold we just talked about.
Exactly. Unlike the primarily rental use where your personal use is strictly limited, here, your personal use is significant enough to trigger these complex hybrid rules. It's often where people land without maybe fully realizing the implications.
And what are the unique, maybe tricky tax rules for this category?
Okay, income must be reported just like the primarily rental category. No surprises there.
Right.
Expenses also must be allocated pro rata between personal and rental use, again, similar to what we just discussed.
But there's always a but.
There is, and it's a big one. What's absolutely crucial here and can be a real trap is that your rental expense deductions are limited to the amount of rental income.
Limited to the income, meaning no losses allowed.
Exactly. No losses allowed from the rental activity in this category. The absolute best you can do for tax purposes is break even, show a net rental income of 0. You cannot use this activity to reduce your other taxable income.
So even if your calculated prorated rental expenses are, say, $7,000 and your rental income is only $6,000, you can only deduct $6,000.
Precisely. You deduct expenses up to the $6,000 income limit, and that's it for the rental side. No $1,000 loss deduction.
Wow, that feels restrictive. Is there anything else specific to this category?
Yes, there's also a specific order you have to follow when deducting those expenses against the rental income.
An order. Why?
It matters because some expenses might be deductible elsewhere if you can't use them fully against rental income. The order is, first, deduct the allocated portion of qualified real estate taxes and mortgage interest.
Okay, taxes and interest first.
Then deduct operating expenses like utilities, maintenance, insurance.
Got it. Operating costs second.
And finally, deduct depreciation.
Depreciation last. Why that order?
Because the taxes and mortgage interest, the Tier 1 expenses, might be deductible on Schedule A anyway for the personal portion, operating expenses, Tier 2, are usually only deductible against rental income. Depreciation, Tier 3, often gets squeezed if you hit the income limit, but any unused depreciation can sometimes be carried forward.
Okay, that makes sense. It prioritizes the expenses that might have value elsewhere. Let's try Garcia one last time in this hybrid scenario.
All right, final Garcia example. This time, she rented her house for 45 days, generating $6,200 in income. And she used it personally for 15 days.
Okay, 45 rental, 15 personal. How does that fit the hybrid rule?
Rented more than 15 days, yes. 45 personal use more than the greater of 14 days or 10% of rental days. 10% of 45 is 4.5 days. Her 15 personal days is definitely greater than 14. So bingo, she's in the hybrid category.
Got it. Total use days.
Total days the house was used is 45 rental plus 15 personal was 60 days.
So the rental portion is?
45 rental days out of 60 total use days, which is 75%. Personal use is 25%.
Okay, 75% rental allocation.
And her expenses. Let's use these figures. Utilities, $1,700, maintenance, $900, depreciation, $1,200, property taxes, $1,200, and mortgage interest, $2,760.
Right, so she reports the $6,200 income.
All right.
And allocates 75% of expenses.
Correct. She calculates 75% of each of those expense categories. If you add up 75% of all those expenses, the total comes to $6,345.
Ah, but her income was only $6,200 and no loss allowed.
Exactly. Since no loss is allowed, her total deduction is limited to $6,200.
So how does that work with the ordering rule?
Good question. She'd first deduct the 75% rental portion of taxes and interest. Let's say that's $1,200.75 plus $2,760.75 tickets plus post $2,970 to $2,975. She still has income left, $6,270 plus $670, $3,230.
Okay.
Next, she deducts 75% of utilities and maintenance, the $1,775 plus $1,270 plus $675 equals the remaining income coverage.
Okay, no depreciation.
The calculated rental portion of depreciation was 75% of $1,200, which is $900. Oh, wait. My previous total calculation was $6,335. Let me recheck. Tier 1, $2,970. Tier 2, $1,950. Tier 3, depreciation, $900. Total $5,820. My apologies. Total prorated expenses $5,820 in this specific expense breakdown.
Okay, so $5,820 in potential deductions against $6,200 in income.
Right. In this version of the example, since $5,820 is less than the $6,200 income, she can deduct the full $5,820. Her net rental income would be $6,840 equals $320. She would report $380 of taxable rental income.
Right. If the prorated expenses had totaled $6,345, then the deduction would be capped at $6,200. And following the order, she would deduct the full Tier 1, $2,945, and Tier 2, $1,950. That uses up $4,920 of the $6,920. She can only deduct $12,080 of that depreciation.
Her calculated Tier 3 depreciation was, say, $1,425 in that scenario. $6,345 total of $4,920. She can only deduct $1,280 of that depreciation.
And the rest of the depreciation, the part she couldn't deduct.
That remaining depreciation, $1,425, $380 equals $145, would generally be carried forward to potentially offset income from the same property in future years. And importantly, the property's basis, its value for tax purposes, is reduced only by the depreciation she actually took, $1,280.
Got it. And the personal portion of taxes and interest.
The personal 25% portion of property taxes, $1,225 equals $300. And mortgage interest, $2,760, $25, $690, totaling $990, could still potentially be deducted on Schedule A if she itemizes.
Okay, so the critical insight for the hybrid category. Your rental activity can never create a tax loss. Max deduction is your rental income.
That's the core rule.
This forces a different kind of tax planning, really focusing on just breaking even or managing minimal profit on the rental side, and then carefully optimizing where you take deductions like taxes and interest.
Precisely. It feels like the IRS is saying, okay, you're using it a fair bit yourself, so we're not going to subsidize potential losses here.
Now, diving even deeper within this already complex hybrid category.
Yeah.
You mentioned there's a fascinating nuance, a difference of opinion on how to calculate some of those prorated expenses.
Yes, specifically for real estate taxes and mortgage interest. This sounds technical, but it can really swing your tax bill depending on your situation.
A difference between who?
Between the IRS's preferred method and a method that has been upheld in some court cases. It all comes down to the denominator you use when allocating those Tier 1 expenses, taxes, and interest.
Okay, this sounds important. What's the difference in their approaches for just those two specific expenses?
So for real estate taxes and mortgage interest, the IRS approach allocates based on the total number of days the property was actually used.
Used meaning rental days plus personal days, like we did with Garcia's 60 days.
Exactly. So in Garcia's case, the IRS would say allocate taxes and interest using a 45-60 or 75% ratio for the rental portion. Remember, for all other expenses like utilities, maintenance, depreciation, both the IRS and the courts generally agree allocate based on total days used.
Okay, so the IRS uses rental days, rental plus personal days, for taxes and interest. What do the courts say?
The court approach, based on certain rulings, allocates just the real estate taxes and mortgage interest based on the total number of days in the entire tax year.
So 365 days or 366 in a leap year.
Precisely. So using the court approach for Garcia, the rental allocation for taxes and interest would be 45 rental days divided by 365 days. That's only about 12.3%.
Wow, that's a huge difference. 75% versus 12.3% for allocating those specific costs.
It's a massive difference, and it dramatically shifts where those deductions land.
Let's use John and his Poconos house to really nail this down. Give us this scenario.
Okay, John owns a Poconos house, rented for 45 days, brought in $8,200 income. He used it personally for 30 days.
Okay, 45 rental, 30 personal. That's 75 total use days.
Yeah.
Definitely hybrid territory since 30 personal days is more than 14 and more than 10% of 45, which is 4.5.
Correct. Hybrid. His expenses. Real estate taxes, $6,200. Mortgage interest, $300 to $400. Maintenance, $1,200. Utilities, $2,500. And depreciation, $3,500.
Okay, now compare the two approaches for John's taxes and interest allocation.
Under the IRS approach, mortgage interest, $3,400 in taxes, $6,200 would be allocated based on those 75 total used days. The rental portion is $4,575, which is 60%.
So 60% of taxes and interest gets allocated against the $8,200 rental income first.
Right. This allows a larger chunk of those Tier 1 expenses to be deducted against a rental income. Because of the no loss allowed rule for hybrids, maximizing these deductions against rental income often helps you push towards that zero net rental income target. You use up more of the income with taxes and interest, leaving less room potentially for operating expenses and depreciation to be deducted against rental income, but maybe zeroing out the rental income itself.
Okay, that makes sense for the IRS way. Now the court approach.
Under the court approach, mortgage interest and taxes are allocated based on 365 days. So the rental portion is 45365, which is roughly 12.3%.
Smaller percentage.
Much smaller. This means less of the taxes and interest gets deducted against the $8,200 rental income. This usually leads to a higher net rental income being reported. You'll likely have more taxable income from the rental activity itself.
What's the potential upside of the court method?
The upside is that a much larger personal portion of the mortgage interest and taxes, around 87.7% in this case, plus the portion related to purely personal use days, becomes potentially deductible as itemized deductions on Schedule A.
So it shifts the deduction potential from the rental calculation, Schedule E, over to your itemized deductions, Schedule A.
Exactly. It's a fundamental shift in where you're taking the deduction.
So this isn't just a technicality, it's a real strategic choice. Which approach is better for you, the taxpayer?
That's the million-dollar question, or maybe the few $1,000 question. It really hinges on your individual tax situation. Specifically, do you itemize your deductions on Schedule A, or do you take the standard deduction?
Now, does that make a difference?
Well, if you don't itemize, maybe, because the standard deduction is higher for you, the IRS approach might be more beneficial. It lets you use more of your property taxes and mortgage interest to directly reduce your rental income, potentially down to zero, effectively getting a tax benefit for those costs without needing Schedule A.
Okay, so IRS method better if you take the standard deduction.
Generally, yeah. It maximizes the offset against rental income. But if you do itemize, maybe you have high state taxes, medical expenses, or charitable donations already, then you need to do the math. The court approach results in higher taxable rental income, yes, but it also gives you a much larger potential itemized deduction for mortgage interest and property taxes on Schedule A. You have to weigh whether the tax savings from the larger itemized deduction outweighs the extra tax you pay on the higher rental income.
So it's a calculation based on your specific numbers and tax bracket.
Absolutely. It's a key tax planning decision. And get this, it's even the kind of nuanced issue that could pop up on CPA exams because it highlights how different interpretations affect outcomes. It shows real-world tax strategy in action.
Wow. Okay, that was quite the deep dive into vacation home rentals. Seriously complex stuff. From finding out when you don't even need to report income.
The under 15-day rule, yeah.
To understanding the nuances of claiming a loss when it's primarily rental.
A big potential plus.
And then this intricate dance of the hybrid properties with their income limits and allocation debates. It's really clear that a little knowledge here goes a very long way.
It truly does. The classification of your vacation home, personal, rental, or hybrid, dictates everything. And that choice between the IRS and court allocation methods for hybrids just underscores how seemingly small details can have pretty significant tax implications. Knowing these rules can genuinely help you navigate the complexities and make informed decisions.
So, as you, our listener, consider all these complexities, maybe think about this. Beyond just the numbers and the tax forms, how might understanding these nuances influence your whole decision-making process? Like when you're first thinking about buying that second home, or even just deciding how you'll use it throughout the year.
That's a great point. Does knowing these rules change whether you see it purely as personal enjoyment versus an income-generating asset? Does it affect how many days you decide to rent it versus use it yourself? The answer might just shape your financial picture down the road.
Absolutely something to mull over.
And remember, for more detailed explanations, maybe some extra practice questions or video lectures to really solidify today's topic, you can always visit farhatlectures.com.
Right. They have comprehensive resources there for accounting students, CPA candidates, and professionals alike. Definitely worth checking out if you want to go deeper.